You think 7% mortgage rates are high? Try 9.5%. Because the latest geopolitical storm brewing in the Middle East isn't just a headline. It's a direct threat to your mortgage payment, and it's already pushing up the cost of borrowing for home buyers. The truth is, the market hasn't fully priced in the real risk, and if current tensions escalate, we could see an overnight affordability crisis that makes the last few years look like a picnic. This isn't about oil prices alone, though that's a piece of it. It's about the underlying mechanics of global finance and how even distant conflicts ripple back to Main Street. We're going to dissect how potential escalations could trigger a bond market freefall, pushing the 10-year Treasury, and by extension, your 30-year fixed rate, to levels we haven't seen since before the 2008 crash. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Folks, we're seeing a chilling parallel between today's geopolitical landscape and the early 1970s oil shock. Many analysts, including Logan Matashimi, are starting to quietly flag the increasing likelihood of a significant energy price spike in the next 12 to 24 months, with some models suggesting a 15 to 20% increase in crude. Why does this matter for your mortgage payment? Because a sustained rise in oil often ignites inflation, and when inflation ramps up, the Federal Reserve has historically slammed the brakes on with interest rate hikes. Consider this. The 30-year fixed rate briefly flirted with 8% last October. If we layer on a significant energy shock, pushing inflation stubbornly above target, we could easily see the Fed compelled to push rates even higher. This isn't just about the rate on your future loan. It's about the very calculus of affordability. In the Phoenix metro, for instance, a 1% jump in mortgage rates translates to roughly a 10% decrease in buying power for the median household. Imagine what another 2 points would do. We're going to dissect exactly how a brewing geopolitical storm, particularly around Iran, could trigger this chain reaction, and what that means for homeowners, prospective buyers, and investors in 2026 and beyond. This isn't just theory, we're seeing the early indicators now. And here's the kicker. The Fed's own secret weapon, designed to keep rates low, just backfired spectacularly, and it's hitting your wallet. Remember 2020 to 2022? The Federal Reserve unleashed quantitative easing, or QE, injecting a staggering $5 trillion into the financial system by buying up Treasury bonds and, critically for us, mortgage-backed securities. Their goal was to suppress long-term rates, and it worked, pushing the 10-year Treasury yield down and with it, mortgage rates. By early 2022, the Fed was the largest holder of MBS, owning nearly 30% of the entire market. They were essentially the biggest buyer of the very asset that dictates your mortgage payment. But then came the pivot. Starting in March 2022, the Fed shifted to quantitative tightening, or QT, letting $95 billion per month roll off its balance sheet, meaning they stopped reinvesting maturing bonds. This created massive supply pressure in the bond market. The crucial mismatch here? While QT was well underway, many analysts and homebuyers still expected rate cuts, but the Fed's relentless reduction of MBS holdings directly contributed to the surge in mortgage rates we've seen. It's simple supply and demand. Less Fed buying, more bonds on the open market, prices fall, and yields, and your mortgage rate, go up. Now, layer on the Biden administration's massive fiscal spending. We're talking $1.7 trillion in 2022 and another $1.6 trillion in 2023. This is a double whammy. More bonds issued by the Treasury to fund that spending at the exact same time the Fed, the market's biggest buyer, is stepping away. This dynamic creates an ocean of supply that the market struggles to absorb, pushing Treasury yields sky high. So, while you're focused on the CPI report, the Fed is wrestling with something far more insidious than just your grocery bill. The Fed says they care about inflation and jobs, but their actions expose a far deeper, unspoken terror: the unraveling of the U.S. Treasury market. While the headlines scream about your grocery bill, the Fed's dual mandate of maximum employment and stable prices quietly conceals a critical, unofficial third mandate: managing asset prices and, most importantly, the gargantuan U.S. government debt. Think about it. The national debt now exceeds $34 trillion. This year alone, interest payments on that debt are projected to top $1 trillion, a staggering sum that, for the first time in history, is set to surpass defense spending. This isn't just a big number, it's a debt spiral. As the Fed pulls back from QE with quantitative tightening, they're no longer buying bonds, forcing the U.S. Treasury to find buyers elsewhere. But with fiscal spending still running rampant, bond yields are soaring, and so are the government's borrowing costs. This creates an impossible trinity. You can't have high government spending, low interest rates, and stable inflation all at the same time. Something has to give. What the Fed really fears is financial instability driven by uncontrolled sovereign debt interest payments. We're talking about fiscal dominance, a scenario where the Fed effectively prioritizes supporting government debt over controlling inflation. If bond buyers dry up, the Fed might be forced into a corner, monetizing that debt by creating new money to buy bonds, an action that would unleash a far more destructive form of inflation down the line. It's a silent, slow-motion crisis, far more perilous than your current grocery tab. But this isn't just an American problem. It's an international one, as the BRICS Plus nations are now actively challenging the very foundation of global finance. Did you know that just last month, Saudi Arabia, the world's largest oil exporter, officially joined the BRICS Plus bloc, a move with massive implications for global finance? And, yes, your mortgage? This isn't just about geopolitics. It's about a fundamental shift away from U.S. dollar dominance, and it's being fueled by nations like Brazil, Russia, India, China, and now, strategically, Saudi Arabia, Iran, Egypt, and the UAE. This alliance, particularly after U.S. sanctions against Russia post-2022, is laser-focused on creating a multipolar world order and dramatically reducing their reliance on the U.S. dollar for trade and their foreign currency reserves. Think about the ripple effect. If these economic powerhouses start trading oil and other commodities in their own currencies, or even a new BRICS Plus digital currency, global demand for U.S. Treasury bonds will inevitably shrink. When demand drops, the U.S. government, to fund its own colossal debt, will be forced to offer higher yields to attract buyers. This isn't theoretical. China, for example, has been consistently reducing its U.S. Treasury holdings, signaling a long-term strategic pivot away from dollar-denominated assets. Their holdings, which peaked at over $1.3 trillion in 2013, now hover around $775 billion as of early 2024, according to Treasury International Capital data. This reduction in demand for U.S. debt directly translates to higher interest rates here at home, making everything from credit card debt to, most critically, mortgage rates more expensive. Nick Gurley of Reventure Consulting has been vocally highlighting how foreign demand for U.S. bonds has been a silent prop for low rates, and its erosion is a significant headwind. Geopolitical tensions, especially around oil trade, and these de-dollarization efforts, are pushing us towards a financial inflection point. So, what happens when this global debt time bomb finally detonates, especially with escalating conflicts like the one brewing in the Middle East? What if I told you that analysts at the U.S. Energy Information Administration are quietly modeling a scenario where crude oil hits $150 a barrel in 2026, directly linked to a potential escalation in the Middle East? This isn't just a theoretical exercise. It's a critical, under-discussed risk that could reshape your mortgage payments. The Strait of Hormuz, that narrow choke point where a staggering 20% of the world's oil supply transits daily, sits squarely in Iran's backyard. With Iran's expanding network of proxies, Hezbollah in Lebanon, the Houthis in Yemen, any full-scale conflict with Israel risks an immediate, severe disruption to global energy markets. Imagine this: a sudden incident, an attack, and those vital shipping lanes become contested. Goldman Sachs analysts, even in their optimistic scenarios, project a 10% global supply disruption could send oil to $120 a barrel. But in a more sustained, direct confrontation, industry veterans like Daniel Yergin, vice chairman of S&P Global, have warned about the potential for prices to soar far higher, even breaching $150. This isn't just about your gas pump. It's about a new wave of supply-side inflation, far harder for central banks to control. The Federal Reserve would face an impossible dilemma. Fight this energy-driven inflation by hiking rates even further, absolutely crushing an already fragile economy and pushing us into a deep recession, or accommodate it, risking a full-blown hyperinflationary spiral. Given the Fed's mandate, their likely response would be a sharply hawkish stance. We saw a glimpse of this in the 1970s. An energy shock today would push the 10-year Treasury yield, the benchmark for mortgage rates, significantly higher. This isn't just a bump. We're talking about a potential paradigm shift in borrowing costs. But what if this isn't just a future risk, but something already baked into the system for 2026? What if your mortgage rate, which we just saw peak around 8%, isn't the ceiling, but rather a temporary pause before an unthinkable climb to 10% or even higher? The confluence of escalating geopolitical tensions, the U.S. government's unprecedented fiscal debt, and the Federal Reserve's relentless quantitative tightening are setting the stage for precisely that scenario by 2026. This isn't just about inflation. It's about the deep mechanics of the bond market. Remember our discussion about the potential Iran conflict pushing crude oil to $150 a barrel? That's not just a gas price issue. It's a stagflationary shockwave. High inflation coupled with slowing economic growth, forcing the Fed into an unenviable position reminiscent of the 1970s. Their tool to fight inflation is always higher rates, even into a slowing economy. But the true hidden mechanism is in the 10-year Treasury yield. As analysts like Logan Matashami at HousingWire often point out, mortgage rates typically track 1.5% to 2% above the 10-year Treasury. Consider this. The 10-year Treasury is currently hovering around 4.5%. If the geopolitical risk from the Strait of Hormuz, coupled with de-dollarization pressures from BRICS Plus and declining foreign demand for U.S. debt pushes that yield up by just 1.5% to 2%, a very real possibility given the current trajectory, we're talking about a 6% to 6.5% 10-year Treasury. Add that typical spread, and you're looking at mortgage rates of 7.5% to 8.5%. Now, overlay the fiscal pressure. 2026 is a critical election year, historically a time of increased government spending, ballooning the national debt even further and putting massive upward pressure on yields. Under this perfect storm of conflict-driven oil shocks, severe fiscal stress, and continued Fed QT, hitting 9% or even exceeding 10% on a 30-year fixed mortgage is not just possible. It becomes a highly probable scenario. This isn't hype. It's the cold, hard math of sovereign debt and global economics converging on your biggest personal asset. So, what does all of this mean for you, the homeowner or the prospective buyer in, say, Dallas or Miami? It means the paradigm has shifted. The era of persistently low rates, fueled by decades of relative global stability and quantitative easing, appears to be drawing to a close. We're facing a perfect storm of geopolitical realignment, escalating conflict risks, and fiscal imbalances that could fundamentally redefine what a normal mortgage rate looks like in 2026. This isn't just a bump in the road. It's a reevaluation of risk that could make even today's 7% rates feel like a distant memory. Given these converging forces, how are you reevaluating your own housing strategy, whether that's holding onto your low-rate mortgage or considering a new purchase? Share your perspective in the comments below. And if you found this deep dive valuable, hit that subscribe button to stay ahead of these critical market shifts with data-driven insights. For a closer look at the local implications, you'll want to watch my breakdown of how these global pressures are specifically impacting inventory and days on market in the Phoenix and Boise metros next.